Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond, and today we're diving into a hot button issue, tariff impact and trade wars. With a universal tariff implementation of 10 to 20% on all imports into the US and a staggering 60% tariff on Chinese goods, the global economic landscape is shifting dramatically. We'll explore how these measures impact industrial production, market sectors, inflation, and consumer prices, and where traders might find opportunities in the chaos. Let's jump in. Let's start with the tariffs themselves. A universal tariff of 10 to 20% on all imports and a massive 60% on Chinese goods represent some of the most aggressive trade policies in recent history. These measures are designed to incentivize domestic production and reduce reliance on foreign imports, particularly from China. While this might sound like a move to protect local industries, such policies often come with significant economic side effects that ripple across global supply chains and financial markets. One immediate consequence of these tariffs is their impact on industrial production and global supply chains. Tariffs increase the cost of imported raw materials and components, which disrupts established supply chains and forces businesses to either absorb the costs or pass them on to consumers. In industrial production, sectors reliant on imported goods, such as automotive, the electronics, and machinery, are likely to experience reduced profitability. Companies may need to localize supply chains, but this process takes time and requires significant investment. Global supply chains also face fragmentation. With higher tariffs on Chinese goods, multinational companies may seek alternative manufacturing hubs in countries like Vietnam, India, or Mexico. While this may diversify risks, it also introduces inefficiencies and potential delays. From an investment perspective, tariffs are driving a rotation between market sectors. One, domestic-facing companies, sectors like utilities, consumer staples, and domestic-focused retailers may benefit as they are less exposed to international trade disruptions. Investors could see opportunities here, particularly in small to mid-cap companies operating within domestic markets. 2. Export-oriented companies. On the flip side, industries heavily reliant on exports, such as technology, industrials, and agriculture, face headwinds from increased costs and reduced demand in international markets. These companies may underperform during prolonged trade tensions. Traders should keep an eye on quarterly earnings reports for clues about which companies are weathering the storm and which are struggling to adapt. Tariffs don't just impact companies, they also affect consumers. Higher import tariffs lead to increased costs for imported goods, which are often passed on to consumers in the form of higher prices. Right? This can drive up inflation, particularly for essential items like food, clothing, and electronics. Inflationary pressures can force central banks to adjust monetary policy. For example, the Federal Reserve might raise interest rates to combat rising prices, which would have knock-on effects across financial markets, including bonds, equities, and currencies. Now, for traders, inflationary environments can create opportunities in inflation-sensitive assets like gold, commodities, and inflation-protected bonds. Right, finally, let's talk about trading opportunities in the midst of these trade wars. Currency markets. Currencies of countries heavily reliant on exports, like the Chinese yuan or the euro, may weaken, creating opportunities in forex trading. Meanwhile, currencies of countries viewed as safe havens, like the US dollar or Swiss franc, might strengthen. Sector ETFs, exchange-traded funds, ETFs, focusing on domestic-facing sectors such as utilities or consumer staples, could offer relatively stable returns. Conversely, traders might short ETFs tied to export-heavy sectors to capitalize on potential declines. Commodities. Tariffs on agricultural goods often lead to fluctuations in commodity prices. Soybeans, corn, and wheat could experience increased volatility, presenting opportunities for commodity traders. And that wraps up today's episode on tariff impact and trade wars. While tariffs and trade wars create challenges for businesses and consumers, they also open doors to new trading opportunities for those who are prepared. Right? Thanks for tuning in. And in the meantime, do remember to subscribe to our podcast here at IronFX, where we're dedicated to bringing you the very best education to take your trading to the next level. Until then, stay informed and stay tuned.